Order, order. Welcome to the Treasury Select Committee on Tuesday, the 24th of February 2026. Today we have one of our regular meetings with the Monetary Policy Committee, or some members of the Monetary Policy Committee. And we've got in front of us as our witnesses, of course, the Governor of the Bank of England, Andrew Bailey, who's in the centre. He's joined by, on his left, Professor Alan Taylor, who's an external member of the Monetary Policy Committee. Dr. Hugh Pill, who's the Chief Economist and the Executive Director for Monetary Analysis at the Bank of England, to Mr. Bailey's right, and to his further right, Megan Greene, who's also an external member of the Monetary Policy Committee. So we obviously have had a series of bank rate decisions, and thank you all for your annual reports about your thinking behind it. We're going to go into the detail of some of the thinking behind it in later questions. But Governor, you've been a swing voter quite a number of times now. And I mean, could you just talk through why you took that position? We've discussed this a bit before, and also what you would need to see to vote for a further cut.
Yes, so I think the good news is that we are expecting inflation to come back to around the target sooner than we were expecting, certainly when I was last here. So I think it's now very reasonable to think that inflation will be around the target in the April number that's released in May. That is largely because of a number of things, but part of that is due to measures in the budget, particularly energy prices, but there are some other developments outside of that framework as well. Now that's obviously good news, but the task for us is not that, well, it's important, but the task for us is obviously then to keep it there and to make sure it stays at target. So our horizon is beyond that in terms of what it takes to keep inflation there. So we're looking very much at what I call the underlying picture on inflation there. Now, again, I think there is good news in there. I think that the pattern of disinflation has been continuing. And I do think, and I've said a number of times, that I do think there is scope, I would expect to see scope for some further easing of policy during most probably the course of this year. Now, in terms of the decision that we took earlier this month, I think that for me the issue was what evidence do we need to see to take a further step down? And I think it was rather premature at that stage, from my point of view, to see that we had that evidence. And that evidence, I said, is particularly on what we're going to see in terms of underlying inflation and how that's going to get reflected through into the position beyond the point at which it drops down to around target. And I think the key question there, we are seeing some softening of the labour market. We'll probably come on to that, I'm sure. Key question then is, with this fall in headline inflation, is that going to get reflected through into expectations of inflation, as is normally the case? How long will it take for that to then feed through into people's inflation expectations and then into, for instance, wage bargaining? Now, we don't need, just to be clear, we don't need to see that actually happen. I mean, that's, I think if we all waited until that actually happened before voting for a further cut, I would certainly take this view. I think we would be too late at that point. But I think, so the question for me, and it will be, as I said in my paragraph in the minutes for the next votes, is have I seen enough further evidence to feel that it's confident to take that step? Well, we'll see. I think at the moment I would say we're still a little way off. Obviously, the next meeting, it is a genuinely open question at the moment.
Okay, and Professor Taylor, you have voted very, very persistently to cut. Do you see? Well, where do you see that going? Because you've also talked about saying 3%. You said 3% should be in our sights now. So if we have slower cuts now, does that mean sharper cuts later, or in your view?
Right. So when I'm voting, I always think about the MPC's mandate, and our mandate is to return inflation to target. But we also have to think about the trade-off between pushing inflation back to target quickly versus incurring too much output volatility. So that consideration has been especially important after the large shock of, post-COVID and then the 22 Russia invasion and energy price shock. So the economy has been quite resilient at first. we were able to combat second-round effects by raising rates, and that was the right thing to do. And the economy didn't suffer the kind of high sacrifice ratios of the 1980s. So I think we were quite fortunate there, and it seemed like a soft landing was possible. And I think we were in that fortunate position because we had anchored inflation expectations, and that was a definite payoff from the kind of mandate-based inflation targeting regime that we've had with an independent central bank for 30 years in place, both in the UK and elsewhere. But I was always concerned that that resilience wouldn't necessarily last forever in the face of restrictive monetary policy. And it struck me about a year ago, probably throughout the last 12 to 18 months, that resilience was starting to go away. And that's shown up in the recent NPR forecasts. Over the course of the last year, the inflation forecast path has been drifting down cumulatively, and the unemployment path has been drifting up cumulatively. So that reflected my outlook in the last 12 months that there were growing downside risks. They seem to have materialized, and that's showing up in 2026 and 2027, with a risk now of undershooting in our latest forecast. So I saw that in the hard and soft data and also in my agency visits around the country. So now we're seeing that. I think the current forecast is in a place that I think manifests those risks and makes plain, sort of where we are on the normalization path. So that's why I've been dissenting over the last 12 months and also in the most recent vote. In terms of where we go next, I would agree with the Governor very strongly. We need to start seeing the final boxes being checked. We can't wait until all of them have been checked, but we need to see the new wages in 2026 coming in, hopefully in line with the agent's survey. I think that would be target consistent. That will then feed through into services price inflation, and as the Governor indicated, the mechanism then would be, we'd expect that to bring expectations down. So that's what I'm looking for, and then I think we will be on a course to neutral.
And Megan Greene, you talk in your annual report about services price inflation as well, but you also talk about wanting to see that firms and households revise down their inflation expectations, because you've voted very consistently for hold all the way through, and you've also done quite a lot of. We perhaps we can talk a bit about the agency visits later, but you've done a number of visits. I think 8 to the regions or something like that. 7. Yeah. And how well, if you can tell us a bit more about why you voted hold, but also how useful the agency visits have been in informing your view.
Yeah, sure. Thanks. So, as the Governor has pointed out, we're expecting to hit our inflation target of 2% sooner than we had been before, and that's welcome news, certainly. Embedded in our central forecast is a sort of nifty handoff where we hit our inflation target sooner, and wage growth and inflation expectations come off just as the impact of fiscal policy on inflation sort of flips. So, part of the reason that inflation will hit our target sooner is because of energy prices, including measures in the budget. Some of that drops out a year from April, of course. And I think that's a plausible and reasonable forecast, but I'm a little bit worried about that handoff not going as planned. And there are 3 things I'm looking at in particular to see whether that's happening or not. One, I'm worried that our forward-looking wage indicators, particularly coming through in the agents' pay settlement survey and also the DMP figures, suggest that actually wage growth has been coming off, but it might kind of stop from here. So that's a worry. The agents have pay settlements at 3.4% this year. The DMP has it at 3.6%. That's not far from where it is now. So that's a concern. I would want to see indications of wage growth coming off, continuing to come off in line with our forecast. I'm also worried about inflation expectations, as you point out, and that goes for both businesses and households who are both part of the wage setting process. So for businesses, if you look at the DMP, their year-ahead price expectations suggest that actually, the disinflationary process might be stalling for them too. And so
you are looking ahead, not at what.
No, I'm looking ahead. That's right. And so I would want to see those start to come off. And household inflation expectations, as you mentioned, have been high, and actually in the latest figure ticked up, not down. So I would want to see household inflation expectations coming down. Now that should happen as inflation outturns come down, but we do know that there's an asymmetry in how households and businesses set their expectations. So they're more reactive to upside surprises in inflation than downside surprises in inflation. So I'm a bit worried that it might take longer.
Is that when you were referring to, I think, in your report about people who are saving more? And is that what you mean?
They're
not spending when things get better.
That's one of the ways that it plays out. But generally, people notice a surprise in inflation when it goes up rather than when it goes down more. And so that feeds through into their inflation expectations more. And so it just suggests as inflation comes off, it might take a bit longer for that to be incorporated into inflation expectations. On the labor market side, which is sort of at the center of a downside risk of weaker demand, I think there are signs of the labor market stabilizing. So even as it has weakened, and we've expected it to weaken, there are indications that unemployment's ticking up because of falls in inactivity rather than falls in employment growth. And there's a risk management aspect to my strategy, which suggests that actually the cost of a policy error is greater if we end up in a world of higher inflation persistence rather than weaker demand.
I know it came quite strongly through on your report that you're looking at risk a lot in that way.
That's right. And just to answer your question quickly about the agents and what I've picked up on all the visits that I've done, I think the agents, the intelligence you gather on agency visits is incredibly useful around inflection points in particular, because so much of our data is lagged. So I will say from what I've heard from firms, it's sort of corroborated a story of generally weak growth, generally flat employment intentions.
And I noticed you also visited a couple of schools.
That's right.
Have others of you done that as well? That's good to. Yeah. The next generation of economists are being well nurtured. And Dr. Pill, you also have been holding for a long while. Do you want to explain your rationale and where you think the glide path is going?
Well, like Professor Taylor, I'm very focused on meeting our mandate of 2% inflation. My assessment kind of has three elements. The first element is the disinflation process towards that 2% target remains intact. And like the governor, I think that is good news. A part of that disinflation process is just the unwinding of the impacts of the big inflationary shocks we had from COVID and the invasion and energy prices. But there is a monetary policy component, and I'll come back to that in a moment. But the second kind of element of my assessment is that disinflation process towards the 2% target is still incomplete. Like Megan described, I think we need to maintain a forward-looking and medium-term oriented approach to running monetary policy, given the lags in transmission and the uncertainties we face. I think it's important that we are not beguiled by the achievement of 2% headline CPI inflation in the spring on the back of a lot of one-off fiscal measures. I think there's an element of us in the past having perhaps given more weight to that than we perhaps should have done. I would therefore, in line with things Andrew has said, maintain my focus on underlying developments in inflation. On my reckoning, in the middle of this year, underlying inflation is somewhere between 2.5% and 3%. That's mechanically a fact of we forecast inflation in the late spring of 2%, but we know half a percentage point or more is coming from these one-off budget-related impacts. And for me, given our target and given that focus on underlying inflation, there is still work to do. And that brings me to the third element, which is I do think, despite the important part played by the unwinding of those inflationary shocks, monetary policy has also played a role in bringing inflation back towards the 2% target over the last few years. While that monetary policy stance that we've set is still restrictive, and I still think it is restrictive, it continues to bear down on inflation, and bearing down on those underlying inflationary pressures remains necessary while we still have work to do. In terms of the sort of things I'm looking for, I share quite a lot of the analysis that Megan's described, so I won't repeat all of that, but just to give one example of, I think, the dynamics which we are dealing with. If we look at the pay settlements survey that is collected by the agents every year, we can see in 2024 that was a number of 5.4%. In 2025, that was a number of 3.9%. And in the survey where we got that number of 3.9%, the expectation for 2026 was 3.4%. So that is very much consistent with the disinflationary process remaining intact. But if we focus on the end 2025 number and see how that's evolved through time, at the time we were making decisions, which, given the lags in policy, we would normally think being relevant for that horizon. So this would have been in the summer of 2024, 18 months or so before. In fact, just when we were deciding to begin collectively that reduction in interest rates, the view given to us by the agents was that pay settlements would be somewhere between 2 and 4%. So let's say 3%, or as the middle of that. Then as we moved towards the autumn, they said it would be in the upper half of that range, so let's say 3.5%. At the time the survey was conducted after the budget in the early part of 2025, the number came out at 3.7%. And then, as I've said, the outturn at the end of last year was 3.9%. So within that overall disinflationary process remaining intact, I think it's been slower than we anticipated, and that's precisely why we're continuing to see underlying inflation above target in the middle and second half of this year. So that's the reason why I think we would need to see more progress on those types of indicators of underlying inflation, services inflation, pay settlements, wage dynamics, the types of things that Megan has discussed in order to proceed. So on balance, I see risk still to the upside of achieving the inflation target given where the current forecast is, and that points me in the direction of some caution in the further reduction in bank rate.
I just want to ask you quick, well, sort of, it's difficult to give a quick answer on some of these things, but how low do you think we can go? I mean, Professor Taylor, you have talked about 3% being the neutral level for interest, the base rate. Do you see any reason to go below that?
Well, I think the neutral rate has this sort of theoretical or hypothetical definition, which is if all of the shocks, real and nominal, had vanished or sort of dissipated, that's where we would end up in a world free of shocks. We know that world is never really observed. So I think, subject to that conditioning, that is where we would end up. Of course, there are upside and downside risks, as Hugh Pill just mentioned. And so would we have to deviate from that? Well, yeah, if we had persistent inflation, we would have to be above that interest rate. If we had, really negative growth, inflation undershoot, or recession, we would have to go into accommodative territory below. So no economic historian can sit before this committee and say, recessions will never happen or inflation shocks will never happen again. They will, and 3% is just, on average, where we might expect to be.
We will get on some of the political and global uncertainties that could have an impact on this. So, Governor, finally to you, the minutes of the MPC have noted that market pricing of long-term interest rates is sloping upwards beyond predictions of what the bank base rate would be. Do you think markets are pricing in that political uncertainty?
Well, actually, we're seeing this around the world. So that pattern in rate curves is common to quite a lot.
So the answer is yes.
Well, let me just explain. Yeah, I think what we're seeing is what the market practitioners would call a term premium. And essentially what that means is that with the level of uncertainty being elevated, markets are demanding a higher return for essentially taking that uncertainty and that uncertainty over longer durations going out. Now, the interesting comparison, you quote the market curve rightly. If you look at the curve that market participants give us in the survey that we publish, the so-called MAPS survey, the market participant survey that we publish at the time of every meeting, where we ask them what they think the actual rate will be, you'll see that curve is about 50 basis points lower. So that reflects the fact that they're demanding this term premium, but when you ask them, but what are rates actually going to be? They've got a lower number, so that uptick isn't in there. So that's a reflection, I think, of the term premium point.
Okay, and are you confident that we're on the glide path still?
Right,
we're on the glide path towards 2% inflation?
Well, I think we've all said that we expect inflation to be there or thereabouts 2% in the late spring. And that is pretty much baked in, given the sort of things we know are coming through. It's a mixture of sort of, we get these annual base effects, which is the sort of things from last year unwinding. We know what the budget measures are, and we know what effect they're going to have. I mean, Hugh was talking about underlying inflation. if you look at the latest number, the number that came out last week, it was pretty much exactly where we thought it was going to be, the headline number. If you look under the lid, goods prices a bit weaker. I think my view is I think we are seeing some trade effects coming through. I think we're probably seeing some trade effects coming through from in goods pricing from China. I'll come to that. Food prices were off a bit more than we expected. But services prices, which I think Hugh and Megan both pointed to,
you mentioned it in your
didn't come off as much as we thought they would.
Okay, well, and
put all those together, you ended up pretty much.
So, colleagues will come on things. Before we move on, though, I noticed that Ms. Greene is sitting in this awkward sunspot, and there is no way we can adjust it. So, Ms. Greene, I was wondering if maybe we just move you to the other end of the table.
Yeah, it's a pleasure to be blinded by the sun. I appreciate it.
But if you do, just indicate we can suspend for a moment just to move you.
Thank you.
Modern rooms designed for meetings, not always perfectly arranged.
No worries.
We can't block it any other way. Okay, so thank you very much for that. I'm going to hand to Dame Harriet Baldwin, MP. Dame Harriet.
Thank you very much, Chair, and it's good to hear that inflation will be back at 2%, which I seem to recall it was back in mid-2024. And I just wanted to ask Dr. Pill, actually, about the impact, because a couple of times you've mentioned the budget at the end of last year, but there was also the budget in 2024. And I remember in the sessions after that budget, we asked the governor what kind of impact that might have on inflation. And we were told that it was obviously too early to tell, that it could play out through higher inflation, through lower wage increases, some loss of employment, a squeeze on profit margins, or potentially a much slower increase in productivity. And I wanted to ask Dr. Pill, now that some time has passed, some time has elapsed since the budget in October 2024, whether the bank has a handle on how the economy has reacted through those 4 or 5 different variables to the changes that were announced in that budget.
Yes, so we have been monitoring very closely the impact of the measures. I mean, in particular, I would flag the changes in national insurance contributions and the changes in the national living wage. Strictly speaking, the latter was announced at the budget. I guess it wasn't part of the budget. I think the margins of adjustment that you listed, we asked at the time how firms, through the decision maker panel survey that Megan described, we asked how firms were going to balance across those margins adjustment. And most firms talked about employing some element of each of those margins of adjustment. I think what we've seen subsequently that has indeed been the case. Mm-hmm. If you look at the path of headline consumer price inflation, so the kind of key indicator of inflation on which our target is based, we have seen this infamous hump in inflation over the past 12 months or so, in large part actually driven by some of these phenomena. And I think that reflects the fact that some of the higher costs imposed on firm were passed through into higher prices.
Can you put a number on that, that in part?
I would say it wasn't the whole story because, as has been discussed, we also had higher food prices. So, I mean, as you know, inflation peaked at 3.8%. Food prices made quite a significant contribution to that, but I think probably about half would be coming through these types of effects. But I think it is important to emphasise that these are, in somewhat loaded language, were seen as transitory effects in the sense that they were one-offs. So as I've described a moment ago, personally, I have focused on the underlying dynamics in inflation precisely because I think these one-off transitory effects should, especially in a context where there is less tightness in the labour market than, say, we saw in 2022, they're less likely to feed through to the more malign second-round effects, disturbing inflation expectations and so forth, which I think would be much more of concern from a monetary policy point of view. I think it's also fair to say that we have seen the other margins of adjustment being influenced. Mm-hmm. So we have seen attempts to lower wage dynamics, a little bit influenced by this, to sort of have overall labour costs reduced. And we've seen in that context also some downward pressure on employment. So the whole combination of those things is playing out into the macroeconomic effect.
Harriet.
So if I hear you correctly, through trying to express this in a way my constituents might find less sort of economist speak, there was an impact on inflation. You're saying inflation did go up, but you think about half of the increase was from the impact from the budget. And you also think that wage increases have been less high than they would have been. Did I hear that correctly? And there's also been some loss of employment. Has the bank put a number on the loss of employment?
I think it's quite difficult to do that. I mean, so I would personally not want to be giving.
It's not been zero.
It's not been zero.
The Office for Budget Responsibility at the time forecast 50,000 jobs would be lost. Has it been higher or lower than 50,000?
I wouldn't want to make a judgment either way. I think that the difficulty is, I'm not sure it's my job to make a judgment on employment. It's my job to get inflation to 2%. That's what we're here to do. I do think there's a lot of other things going on, and separating this specific element from those other things is quite difficult. I think we will talk later, if I understand the agenda correctly, around structural changes in the labour market. And I think I am of the opinion that those structural changes in the labour market have been quite profound, but they are a bit lower frequency.
We will get on to that.
They're less about the specifics that we've seen associated with specific measures at specific budgets over the last 18 months, but they're more driven by wider developments in the economy, and I think those continue to influence the employment situation.
Let me ask the question slightly differently then. There are 150,000 fewer people on payrolls than there were at the time of the October 2024 budget. How much of that impact was a reaction by employers to the measures in the budget?
Again, I don't think I can give a precise answer to that for the same reason I just said. I think there are many factors going on. I think, as has been discussed by others, over the last 18 months or so, we have seen an easing in the labour market, a cyclical downturn in the labour market. I think that accounts for part of that change. I think we've seen some changes in the structure of the labour market which are more long-lasting, which I think have also resulted in a decline in employment. And separating out the impact of these one or two measures, I think, is very difficult.
And what about the squeeze on profit margins and the potential improvement in productivity?
Yeah.
Are you perceiving any of that in your data?
Yeah, so I think we have. I think we have seen, and certainly the information we get, as Megan described, from the decision maker panel, which is a survey conducted by the bank on which we put quite a lot of emphasis and focus. I think all of those dimensions are ones that are mentioned by firms. Again, separating these things out is very difficult, especially in real time. But I would say that profit margins have seen in some sectors a squeeze. And the question forward-looking is that going to be recovered, which would tend to boost inflationary pressures, or is it going to be resolved in terms of squeezing costs in the future? So this is still something that has to play out. And I think also there are clearly efforts, and these are discussed to some extent in, I think, Box C of the Monetary Policy Report, to try and raise productivity. We have seen quite high levels, at least, of an attempt to adopt AI in the UK corporate sector. And we've published some work on that even this week. But also I think there has been an element of shedding labour that perhaps had been hoarded in the period following the end of the furlough, where the labour market was very tight and the difficulties in recruitment were intense, and the return to trying to retain labour was seen as high, and that mechanically leads to a little bit of a recovery in productivity on a cyclical basis. So I think on all those margins, firms are trying to adjust, as you would expect.
Does any other member of the panel want to try and disentangle the way in which the economy reacted to the measures in the October 2024 budget?
I think the only thing I would add, and it sort of backs up what Hugh was saying, if we take this employment point, if we go back to hearings we had in the past, I think when you were chairing the committee, we talked about the labour market being tighter than expected, and there was hoarding of labour. It sounds rather pejorative, but firms were retaining labour because they were worried if they lost them and wanted them back, they would find it difficult. Certainly on the basis, I think, of evidence our staff are producing, that hoarding is unwinding. In other words, there is a reduction of labour. Now, Hugh's absolutely right. The problem we then so you can observe that, and the budget measures sort of fall during this period.
When you say so, the hoarding's finishing. Does that mean that people are releasing people, but they're finding?
Well, or they're not hiring. I think that it's probably at the moment we're not seeing a particular uptick in redundancies. It's a bit of a volatile number from month to month, but I think if you look sort of over time. What we are hearing, and we pick this up when we go around the country, I certainly do, is just not hiring. So obviously that will have the same effect. Where I very much agree with Hugh is that I think the problem is, I understand the desire to apportion the causes here. It's quite hard, though, to apportion the causes. I think there is, as Hugh has said, an element of responding to the change in the cost of employment through this channel of employment, but giving any precise number, we can observe, as I say, that I think this hoarding going on. Apportioning it is quite hard.
No, I just don't know if you come in on this.
If you come on, carry on.
Shall I carry on? Dr. Pill, you mentioned cyclical rise in unemployment, and you alluded to some work you've done on the structural change in unemployment due to potentially artificial intelligence and companies trying to use that. And I just wondered if you wanted to tell the committee where you think we are in the cycle, and given that unemployment has breached 5% for the first time in a long time, is there a significant risk, in your opinion, that in order to meet your monetary policy objectives, that unemployment is going to continue to rise?
I don't think there's a mechanical link between higher unemployment and lower inflation. I think it depends very much on what are the drivers of the movements in those two variables. So we've talked quite a lot in the past, I think on a previous occasion here, is if you have positive developments in the supply side of the economy, then you can have stronger growth and maybe stronger employment at a time when inflationary pressures are diminishing. Whereas if you have more driven by demand, negative developments on the demand side, that would tend to push up unemployment and at the same time diminish inflation. So the interaction between unemployment, or the correlation between unemployment and inflation, I think can go in opposite directions depending on what the underlying drivers are. The point I was trying to make earlier is, I mean, obviously the tax changes and changes in the national living wage you mentioned are one element here, but they're really, I think, not the most important element in an environment where there are very many fundamental changes in the economy going on. And I think those go on over quite a long period. So, I mean, of course, we can go back to the onset of the financial crisis. This is now approaching 20 years ago. But behind that, we saw quite a big change, at least on the measured data, in the productivity dynamics in the UK economy. And that has a big effect on the cost effectiveness and the demand for labour through time. And that's really quite an important driver of what the potential of the economy is. We've also gone through the experience of Brexit, and Brexit has had quite significant structural impacts, in my view, on the behaviour of the UK economy. We had a period prior to Brexit, or prior to exit from the European Union, of free movement, which allowed people from continental Europe to come and work in the UK. That not only created more flexibility in the UK labour market, it sort of imposed a discipline on behaviour in the UK labour market because of the potential for people to arrive. They didn't actually have to arrive to impose that discipline. We've seen quite big changes in migration from non-EU member states, both post-Brexit and subsequently, different regimes. That's gone up a lot and come down a lot. And as Andrew himself described a moment ago, through COVID, through lockdown, and with the implications of those two things for different parts of the labour force, we've also seen quite sharp changes in participation rates in the UK economy, generally on the negative side, but of late a little bit more positive.
So cyclically, you think we're in a sort of unhoarding, as you would put it, of labour? I mean, how far into that cycle are we?
Yeah, so cyclically I think we are seeing weakness. So, for example, a good indicator in our thinking of the cyclical state of the labour market is the ratio between the vacancy rate, which is a measure of how many firms are looking for workers, and the unemployment rate, which is a measure of how many workers are available for work. That was very, very high by historical standards in the sort of immediate aftermath of the lockdown. That was the period where, as I said earlier, the labour market was tight. I think probably surprisingly tight relative to what was expected as we came out of lockdown. And that was a moment where high rates of inflation were threatening to create these second-round dynamics, which could lead to, and I think did lead to some extent, more persistent high rates of inflation. What we've seen over the last year and a half, 2 years, has been a significant fall in that ratio of vacancies to unemployment. I mean, a fall which takes it below what we would probably see as the equilibrium level based on historical behaviour.
How does the cycle have to go?
Well, on the latest data, and this is the more optimistic aspect, is that fall in the vacancy to unemployment ratio, which has been quite sharp, has now tended to stabilise. And I think of late, we've seen some rise in vacancies, we've seen unemployment rise, but more modestly. I think that the problems that we've discussed on previous occasions with the labour force survey, from which the unemployment rate is derived, maybe mean that the data we've seen over the last few years is less reliable than otherwise might have been. And that might mean that we see better estimates of what the level of unemployment is now, but the changes from what we saw a few years ago to where we are now may not be very reliable. And if you look at indicators like the Workforce Jobs Survey, or you look at indicators like the Payroll Survey, they are beginning to sort of flatten off. So I think from my perspective that we are getting to a point where the labour market is showing signs of stabilisation.
So 5% now. What's your forecast as to where it will peak?
Well, the forecast that was published in the Monetary Policy Report, so that's sort of endorsed somehow by the committee as a whole, that is that we will see 5.25% in the second half of this year. So not much rise from where we are.
One final question, if I may, is obviously one of the standout concerns has been unemployment for young people. Yeah. And, is again that consistent with what you would expect the labour market to be doing in this unhoarding phase that you've described it as, or this part of the cycle? How much worse is employment going to become for young people?
I do think, I very much
share... Also you mentioned the AI report.
So I very much share your concern about unemployment, particularly for the younger people. I have a daughter looking for a job, so this is a very immediate experience personally for me as well. I would say that some of the changes that we discussed earlier around tax and national living wage, they have been particularly had an effect at the 16 to 18 and 18 to 21. And that's because some of the changes, as you know, have been to move some of the special lower rates of the national living wage up to the normal rates on that margin. And similarly, the changes in the national insurance contributions were affected.
£4,000 more to employ a young person.
Had the impact of the thresholds, etc. So both of those things have had a particular effect on young people. I think that also has to be seen in the context of some of the changes. Sorry, I'm now getting the light on me. So.
We're all going to get it eventually. Alan and I are waiting.
So some of the changes coming from that have been particularly acute for that part of the labour market, and I think we do see that in the data. I also would agree that some of the deeper structural changes, the fact that many sort of entry-level jobs are being affected by AI, I think that is something that perhaps is difficult to manage. The surveys that we see thus far talk about a lot of UK companies taking up AI as a way of trying to improve productivity. As yet, they don't report that's resulted in a large reduction in their willingness or ability to employ labour. But of course, on a forward basis, I think that remains an open question. I also think in that space, there are these issues about the echo or long-lasting effects coming out of COVID. So particularly, as I know many of you know and have discussed in the past, having your first job is an important part of being able to enter the labour market and be productive. The more difficult that is, or can have very long-lasting effects, and they do cross with things like health issues, mental health issues, and so forth. So these are things that I do think post-pandemic, with those issues having been to the fore, that they're. So I think it is that margin that I would have most concern. Can I
just ask, we've sort of skirted a bit around the relationship between the national insurance contributions. You mentioned it in a bit more detail there, Dr. Pill, and the impact of that on unemployment, which is, there's a political discussion obviously going on about that, and a neutral and technocratic assessment, because it's possible to. Can I just, you've been out to talk to, done your visits around the country, so perhaps starting with Professor Taylor, just your quick take on what impact that has had on unemployment. Have you picked that up from agencies? It's had a big impact.
The impact from
on the next raise, has that had a big impact on people not recruiting, therefore, and how that flows through to unemployment?
Yeah, that's
quick answers on this. And Dr. Pill, did you want to move to the end? Would that be
just I think if Megan can do it?
Right. It's now a matter of honour. Okay. We'll make sure we don't use this room in the afternoon in the future. So apologies for that. Sorry, Professor Taylor.
Yeah, so I think that has been a recurring theme in conversations I've had with businesses around the country in the last 12 months. So, but it's not the only theme. So I think that came through very early on after the budget, and I think they were taking measures to adjust. But I think it's important to emphasize, in the context of the discussion, there were many other things that were on their minds. Global uncertainty, for example, and the restrictiveness of our monetary policy, which is part of the story. And I think, going back to the evolution of our forecast that I spoke about earlier, it's interesting that in February and May, I think our staff forecasts had tried to incorporate as best as they could the effect of that 24 budget. And those forecasts had unemployment peaking in maybe the high fours. But it's the revisions in November, and particularly now in February 2026, where we see the unemployment path moving up much more dramatically. So I think that's in line with what I said earlier. Those moves to me are more a manifestation of the continued global uncertainty and the continued level of restrictiveness, and also the impact of our restrictiveness on the economy.
Well, because we'll come on to some of the global stuff. Governor, on that.
I would just emphasise monetary policy is a blunt instrument in this respect. I mean, we can't use monetary policy. We shouldn't use monetary policy to target.
We are also talking globally about these figures.
But since you asked the question about what do we observe sort of going around the country, and I would just add the statistics to this. I think the youth unemployment rate, or the young person's unemployment rate, is around 16% now, which is actually high. Let's be honest, it's high. It's gone up more rapidly than the overall level. I think it's also interesting that the regional pattern of unemployment is quite unusual in the history of this country at the moment, because I think I'm right in saying London has the highest rate of unemployment amongst the regions. That's quite unusual in British history. It's also interesting, I was in Belfast last week. Northern Ireland is a completely different economy in this respect. Now, I think you do have to, as Hugh was saying earlier, you do have to sort of be careful in terms of looking, particularly when you get down to the wider effects of this, at looking at both the unemployment rate and the inactivity rate. So, if you take Northern Ireland as an example, it has a much lower unemployment rate, but it doesn't have a lower inactivity rate. But I do think we can offer, we can share the intelligence we get when we go around the country. But monetary policy is a blunt instrument. It's not an instrument that we could use to target this sort of thing.
Megan Greene.
Yeah, sure. So if you look at the decision makers panel, when we ask companies how they have already responded to it, it seems like the biggest margin has actually been margin compression. So there is a question, as Hugh mentioned, about whether firms try to recoup that, given that it's been eating into their margins. Headcount does come up. I think it's the second biggest. When our agents go around and talk to firms, they have been telling us since, I believe, at least September, that firms are saying to them that the adjustment has largely occurred now.
So it's sort of absorbed into that.
That's right. And then just one really quick point on AI. I think there is a challenge with surveys. Almost every firm I talk to on my agency visit says emphatically that they're incorporating AI into their work, but when you ask them details about what kind of AI, it turns out a lot of it isn't AI at all. It's actually just automation. So I do think that some of this survey data just needs to be taken with a grain of salt, because we all have different definitions of what AI is.
Okay, thank you very much. I think I'll turn to John Ben briefly and then go to Ms.
Yes, a few weeks ago, Lord Jim O'Neill was suggesting that the changes in national insurance and national living wage were perhaps causing employers to think about the value of additional labour capacity, and there was potentially some signs that it was addressing the productivity challenge we faced. I wonder if any of you had reflected on his reflections and have anything to endorse or not that observation, and when would we see data on that? Because it's quite material to the economy.
It's right to say we are beginning to see some signs of some uptick in productivity, and we have built a bit of this into our forecast. Now, the question then, which I think Jim O'Neill's comment goes to, is what's causing it. And you can sort of broadly tell two stories there. One, and you can have both, by the way. One is the story that Megan was just referring to, which is investment to improve productivity, and the other one is obviously shedding labour to improve productivity. There is also another story you can have, obviously, which sort of follows the second of those, which is firms that were sort of, in a sense, struggling at low productivity rate exiting, which will in aggregate increase productivity as well. And I think it is quite possible that we're seeing both of them going on. I certainly would endorse what Megan said about firms saying they're investing in AI. And you do see, I find when I go into firms, you get a very different, you never quite know what you're going to see when you walk in at investment levels. But there is, the UK, on the face of it, I think, we're not seeing what the US is seeing, but I think such as the evidence is, would suggest we're probably ahead of a number of other economies. But I think Jim O'Neill's right. This point about dishoarding of labour may well come through in somewhat higher productivity.
Okay, thank you. Catherine Weston.
Thank you, Chair. If I could pick up the point on regional levels of unemployment, both the general rate but also for young people.
Yes.
What assessment have the experts here made in relation to what works in terms of government interventions? It's still early days for this government, but there is an effort around apprenticeships and those sorts of more dirigiste approaches to youth unemployment. And I'm wondering, is there any evidence from going around the country which of these approaches is effective, or does the data not really give us much to go on?
We're not, I do think that's a question really to ask the Treasury and others in government. I will give you one reflection on apprentices, because the Bank of England operates an apprentice scheme, and I think we like it, and we think it's a very good thing to do. That's as an employer, so I can only speak as one employer, but I think it's worked well for us, and we're going to continue it. It's a good thing.
And the second question I had was in terms of the other regional elements of unemployment. Obviously, you've mentioned London, but other regions where there may be older industries which are now no longer providing jobs, that sort of thing. Are there any reflections which have come out of the surveys and the visits about where there might be other pockets of deep unemployment around either young people specifically or the general population?
Well, I do think that this question that, again, Hugh obviously gave the very correct health warning on the labour force survey, which but if you look at the labour force survey over time, you see this trend in inactivity, and there is, it's at both ends of the age distribution, and there's this sort of, I think it's NEAT, isn't it? The not in employment, education and training for the younger people, and that is evident in the inactivity numbers, and I do think that's concerning. Again, we can't. I'm afraid monetary policy isn't the tool. But it is obviously concerning if young people are not in the labour force.
There was one final point that I just wanted to pick up in relation to the sort of how the surveys are validated, and sort of what margin of confidence we can have in the surveys. It sounds very good all going out and talking to employers, etc. But for example, nobody today has raised the cost of power and energy in companies, for example, whereas that's had a big write-up this week in the papers. So wondering sort of how are the data captured when the surveys are done? And how confident can we be in their results?
So I think that's a very good point. So, there is a danger. I also go on regional visits and talk to our contacts through the agency network in various ways. There are great benefits to that, but there is a danger of being over-reliant on an anecdote that is convincing to you in real time. So you need a bit to manage that. I would say, though, what's important is we complement that relatively small sample of going to talk to 5 people in Coventry, which is what I did 2 weeks ago, with the agents putting in an increasingly quantitative and systematic way. So we're using internally also AI techniques, natural language processing techniques to convert interviews or discussions into quantitative data that we can then compare through time and across regions and in a more systematic way with a much bigger sample. So there's a lot of effort within the bank to use new technologies to try and address your problem. But more importantly, we don't rely just on our agency input. That is complemented by, as Megan has emphasised, the decision maker panel. That's an online survey of about 7,000 key decision makers in firms across the UK. That's a survey that's now been running for the best part of a decade. And so there's quite a lot of statistical analysis validating the results of that. Of course, if we find outliers, we find kind of rogue respondents, we're always on the lookout for that. And we have a lot of other surveys run by both the bank itself on the consumer household side, but also by many others. The PMI survey, which looks at corporates, the CBI run surveys, Lloyds Bank run surveys, many others run surveys into the household sector. We saw the British Retail Consortium survey today. So these surveys are all cross-checked against one another and with the official data and with other sources of data. So there's a lot of attempt to combine the information in a very comprehensive way before we draw very strong results. And at the moment, one challenge is indicators that might purport to measure quite similar things often give us different perspectives. For example, the labour force survey relative to the information we have on payrolls coming out of HMRC. And that's a challenge for us, is to reconcile these things, and that's a big part of our work.
Yeah, Professor might want to come in.
Professor Taylor?
Well, yeah, I would actually just say if there was a silver lining to the problems of, the official statistics and ONS, it was that, and I've seen this in the last 18 months on the committee, that the staff have worked tirelessly to try to come up with alternative ways of taking the survey data and other time series data, applying appropriate statistical techniques to filter them and say, where are we getting signal, where are we getting noise? Are they telling us a story that's consistent historically with the official data, and to what extent can that provide a guide to us when the official statistics may not be reliable? So I think something good has come out of it, but hopefully now we'll be back to having both the official statistics and these additional measures. So I think that's a good thing.
Thank you. And yes, this committee has been watching closely the labour force statistics, which we're keeping a close eye on. Thank you very much indeed. John Denenty.
Could I ask Professor Pill about the monetary policy report's analysis that says that 40% of UK workers are employed using bargaining firms who pay collectively, and I think it says they react more slowly to inflation. So I guess you've got a situation where a significant portion of the workforce, I've got people who are keeping the inflation, the expectation higher. Now, I think you've said that you draw different implications from the analysis. Would you like to explain that to us so we can get a grip on what's the range of views, and perhaps your colleagues might want to come in to offer a complementary perspective afterwards?
So if you may, I don't want to go on this too long, but it's quite important, I think, just to clarify what the box B of the Monetary Policy Report does. So this is an exercise which tries to use statistical techniques, again, modern AI-type statistical techniques, and a very detailed data set, firm by firm, called the ASH data set, which is available annually for the last 20 years, to try and classify firms into certain groups, reflecting how those firms set about behaving in when they set wages, right? Now, that work, which is in some sense a black box statistical exercise, has then been cross-checked with the input from the DMP and input from the agency network to kind of understand, is what this black box statistical exercise spits out, is that somehow chime with the lived experience of our agents going to firms? So this has been a project that's been running about 6 months, and it's trying to understand how firms set about setting wages, which I think is an absolutely key thing, as was reflected in the discussion we had earlier. When you're aiming to achieve the 2% inflation target, etc. Maybe a key thing in general, but it's particularly key in that context. So there are these 4 groups. One group is labelled the bargaining group. I think it is important to emphasise that it's not that everyone in that bargaining group somehow has a collective bargaining arrangement. It's that they behave in a way where the firm, when setting wages, engages in a bargaining type interaction with its workforce. And as you say, a characteristic of that is wages tend to respond to firm level and macroeconomic data in a slightly lagging way, but a more persistent way. So this is what might be imparting greater persistence to the inflation in the aftermath of the big kind of shocks we saw with the COVID pandemic, with the invasion, with the impact on energy prices and so forth a few years ago. And that might help to explain why inflation has come down more slowly than had been expected. It might help to explain why pay settlements and wage dynamics have tended to be stronger than you would have expected on the basis of the models that the bank had in place that were estimated on the much more benign period from the late 1990s up until the financial crisis and so forth. So that's the sort of starting point of what this box shows. So my perspective on this is, and we've talked about this a moment ago, my perspective on this is what the results show is about 40%, as you've said, of the firms in the sample behave in this bargaining way. If you incorporate that information, you can explain about a third of the otherwise unexplained strength and persistence of wage dynamics in the aftermath of these big shocks. So it doesn't explain everything, but explains a substantial part. And crucially, from the perspective of what you're saying is, that 40% does not seem to have changed that much over the period which this analysis is done, from 2008 up until the present day. Now, the key point here is, I was arguing earlier that there have been a number of structural changes to the labour market which may have resulted in more persistence in inflation that concerns me as we go forward. And maybe we'll come back to that. Where I kind of disagree with this analysis, and I should emphasise that I have been a sponsor and enthusiast for the actual analysis. So the analysis itself, I think, is very strong, and it's a good example of bank staff using modern statistical techniques, exploring data in a novel and innovative way to try and inform key questions that the MPC has to discuss. So I'm very enthusiastic about this work, and hopefully we can develop it further, and indeed embrace some of the data from HMRC and so forth that we talked about a moment ago. But the kind of key point is, I don't think you can conclude on the basis that that 40% share has been relatively stable over this sample, that there has been no change in the structure of the labour market. Okay. And so my view is there has been a strange change in the structure of the labour market, and the burden of proof is to prove that hasn't been the case, and I don't find this compelling evidence.
Professor Taylor, do you want to comment on this, or do you have a different view in any way?
I don't know if I have a dramatically different view. I mean, as you said, it's an annual survey, and I think it's very good for retrospectively understanding the past and whether the dynamics of membership in these groups changes a lot. But right at the moment, in real time for policy making, that sort of once-a-year survey isn't going to help me, in the next 6 months or at each meeting. I think for me, the most important thing is to look at spot wages and settlements as they're coming in. We get that update every month. We can then cross-check that against what the agents say they were expecting. I was doing that month by month with my team throughout 2025, and we saw those wage settlements coming down from high threes to mid threes to low threes, and that's what gave me increasing confidence. And if we see those numbers keep printing in 2026 in that range or lower, we know that disinflation process for wages is continuing. So to me, that's the big story that's been happening over the last 2 or 3 years, not whether there's been some movement between these bins.
I mean, I'm not trying to draw out differences for the sake of it, but I'm trying to understand the range of perspectives. But I mean, I suppose what I'm getting to is that you think that household expectations are more backward looking, or no? I mean, how do we weigh up the differences and how to, what's going right or wrong in terms of these data points that you're dealing with? Because you've got to make a judgment, you publicise your decisions, but for most people watching this, they'll find it, well, as we do, quite complicated to break down. I mean, what is it you're saying about expectations of inflation going forward, that actually the reality is now is that it's at a lower, settlements are lower than the lag suggests they might be, and therefore we need to deal with that reality more than worry about what the data might show us in time.
Yes, I think there are two linked points here. One was about wages, which we were just talking about, and I think if there was excessive persistence or some structural change, we wouldn't even have got as far as seeing settlements in the low threes right now, but we have reached that point. And going forward, given our forecast, we expect even more slack in the labour market, and therefore maybe even more downward pressure, or at least negative pay drift relative in terms of showing up in the AWE number. So all of that to me says it really is intact. And as the Governor said earlier, we're checking off the last few boxes here, and expectations might be the last box to tick. But we do have the staff have a model of how expectations react to lagged outturns, and if that proceeds as normal, we'd expect the lower inflation coming down the pipe in 2026 to pull down on expectations, and we'll be watching for that.
Right. Does anyone else want to say anything on this subject?
I mean, I agree with you. I think it's great work. I think it helps to. I think it helps to explain why we've had this pattern of wage settlements coming in above where our standard models would suggest they would. I think it probably helps to explain that. I probably differ a bit. I do differ a bit with you. I think in the context of a weakening labour market, I'm not sure how strong a signal I would take from it of that nature going forward. So I think how it's going to behave henceforth, interesting to see. But it's great work, and as you said, it's a good example of how we're developing the tools as the technology develops.
Thank you.
You looking to come back? Is there anything?
Very briefly.
Right. Yeah, so I mean, the tools are great, and we will, if we can use the HMRC data, that is monthly data, so we can increase the previous.
More data.
But the point I wanted to make is, and this goes back actually to something Megan said at the beginning, and I also want to emphasise, is it is true that from various sources, pay settlement data is lower than it was last year or the year before. So that's the kind of notion of disinflation being intact. It is also true that if you look at the latest movements in that data, so just to take one example, the IDR data on settlements, just to give a concrete example, the latest data is going up, not down, right? So that's where I think that you have to be a little bit cautious. And that's why, relative to where Professor Traylor is, I am more on the cautious side, is that I see evidence of stalling may be too strong a word, but flattening out or something like that in some of the underlying inflation dynamics. And that is the reason why I am on the more cautious side of moving further with interest rates at this
Megan
point.
Greene, you're nodding there. I agree.
Yes, so I agree with that, as I set out in my opening comments.
Yeah. Thank you. Luke Murphy, MP.
I mean, actually, just briefly to extend this discussion slightly, which is, I think you've kind of alluded to it, but maybe not gone into so much detail. In combination to this new modelling, Dr. Poole, you also view other changes around immigration, tax and regulation. You view that as a cumulative effect that we should be, I think the quote that I've seen in the FT, that we should worry more about wage pressures as a result of that. In your view, reduction in flexibility in the labour market. And I wondered, to the degree beyond the modelling point, others on the panel agreed or disagreed with that sentiment about we should be worrying far more about wage pressures because of the changes in flexibility of the labour market that Dr. Poole has identified, although Professor Taylor wanted to comment on that.
Yeah, I mean, I would reiterate my previous point that in the spot settlements we've seen for the last 6 months or so, wages have been coming in the low threes. So that wage pressure has been pulled down by the cooling of the economy, and wages had to naturally catch up in terms of the real wage level relative to where they were 5 years ago, given the inflation shock. So some of that is natural catch-up. I would agree with Hugh Pell. I mean, if we see wages printing in those monthly data in 2026, if you see those prints going up, as that most recent print did, if that were a persistent pattern, you'd have to think again. You might have to pause, right? I think the more longer-term issue, and I think Hugh and I would agree completely on this, is what's long-term productivity? The view we have of what is long-term sustainable nominal wage growth depends on our productivity assumption, which is 1%. And that matters, for everything in the economy in terms of well-being and living standards over the longer run. So for me, the really key question in terms of sustainability, inflation remaining at target not just in 2026 but 2027 and beyond, is are we going to see those outturns in productivity? And that's really, to me, the whole ball game.
Okay, thank you. John Grady, MP.
Thank you very much, Dame Meg. Governor, just briefly, the budget announced various measures which bank staff estimate will reduce inflation by 0.5 percentage points in April. Do you see those measures, and does the committee see those measures as having a longer lasting effect on inflation and interest rates in the medium term?
Well, I think that comes back, that draws on things we've said. We are looking beyond that. So the question is, will those measures which bring inflation near down to, as I said, around target, then feed through into expectations, feed through into wage bargaining? That's the key thing, really. Now, that will be influenced by a lot of other things, as we've been talking about, particularly we've been talking about the state of the labour market a lot. But I think an important aspect of this is will this contribution from these measures in the budget have that effect? Now, Hugh's absolutely right to say, look, we have to look through that and say, underlying inflation is not at target at the moment. But the question is, will this combination of what's going on in the labour market and then, will there be some contribution from these measures in terms of the effect they have on people's expectations of inflation going forwards? Will that have a beneficial effect? And as I said, I think in my opening response to the Chair's question, that will be very key for me in terms of judging.
Thank you, Governor. And a question for Ms Greene. You gave an interesting speech in Glasgow, a great place to give a speech, I must say. But one of the points you make is you talk about the supply side and monetary policy being a relatively blunt demand side management tool. So when we look at the budget, does it point to a wider point that governments need to be more attentive in general to the effect of their policies on inflation, and we're putting too much weight on monetary policy in addressing inflation?
Well, so I will say generations of economists have only learned to think about the economy through the demand side. And so, governments, central bankers, we should all think more about the supply side of the economy, I think. But getting inflation to the 2% target is our job. It's not up to me to tell the government what their job is. But I think we should all be considering supply shocks, least of all because we've had a few over the past couple of years. And in my view, we're going to continue to have supply shocks going forward if you consider the implications of things like climate change, economic statecraft, which seems here to stay. Those all represent negative supply shocks for the economy. So I think we all need to consider it.
Whilst you're being quite shy about pointing at others who need to take action, you would say that governments and others would do well to consider potential supply shocks such as climate change and address them with a view to mitigating the risk of inflation.
So I think all economists should think more about supply shocks. And the traditional view is to look right through them. I think that maybe that hasn't served us that well as economists over the past couple of years, and we should learn those lessons.
And briefly, on the back of a budget which tackles inflation by reducing it slightly, do you think there's more for governments to do to think about the impact of their policies on inflation, Governor?
Well, I would always say that the governments do need to consider the impact on the price level of their decisions. So I would say that. But of course, our job is to take those measures into account and essentially come up with our judgment on monetary policy, and we'll always do that. Megan's right. We're seeing more supply shocks, we're seeing bigger supply shocks as well. And they are tougher to handle in any policy framework because we can't directly address them. But it's our job to do the best thing we can with them, and we'll do that wherever they come from.
Mr. Taylor, anything to add?
Yeah, I would agree with Megan and with the Governor. I would maybe just add to that the need to consider supply shocks and other sources of inflation. It's not always and everywhere a monetary phenomenon, despite what we read in the textbooks. And if you look back over the last 70 years, what are the two big shocks that have completely messed up inflation targeting? They were oil shocks and energy shocks and gas shocks. So energy prices are exogenous to this country. We take the world prices given. And those are the two big events that have really knocked us off course. So that's food for thought.
Thank you.
Thank you very much, John Greene. Catherine West MP.
Thank you, Chair. Is it the view of the panel that the COVID stimulus has worked its way through now? There was some commentary at the time that some companies were artificially carrying on due to some of the COVID loans. I was wondering whether in the survey data it's become apparent that that's sort of finished that phenomenon, although I understand some of those loans were on a 10-year basis, the COVID. So is there any of that that's still to be worked through and therefore have an impact on productivity?
There were some of the small firm loans loans were smaller. I have to be honest, it's not a feature that figures particularly in our discussions. I mean, the point of productivity, I think, goes back to what I think I said in response to Mr. Glenn's question, which is you can get an increase in productivity by less productive firms coming out, as it were. That's a contribution that can happen. It is possible that those loans, done for good reasons, by the way, don't get me wrong. That was a very different time, but they may have prolonged the life of some firms that would have had a shorter life, and that could have an effect on productivity. But I don't want that to be, in any sense, a criticism of that policy, because it was done for very good reasons at the time.
Okay, so interesting that it's not materially noticeable. Is it because it's the small firms particularly? Okay, thank you. Jim Dixon.
Yeah, thank you, Dame Meg. Just a couple of questions about the global outlook, but particularly looking at events in the US. We clearly now have a presidential nominee as the new chairman of the Federal Reserve, coming after a long period in which, to put it politely, the president of the US has attempted to cajole the Federal Reserve into cutting rates probably more quickly than it perhaps wished to. But we have a nominee who is very much the president's nominee, obviously subject to Senate approval. Are you of the view that this particular nominee will uphold the independence of the Fed, which we know is very important to both the US economy but the world economy as well?
Well, I've known Kevin Walsh for a long time because he was a governor of the Fed actually during the financial crisis period, and our paths have crossed a lot ever since. I think it's a good nomination. I've said that before. I said it in the press conference we held. Look, Kevin should speak for himself, obviously, but from all I know, and I do know Kevin, I think he is a strong believer in central bank independence.
Mr. Dixon.
He appears to be on record as being very critical of the way in which the Fed has operated for the last 10 years plus. I think he's talking about potentially overhauling some of its approach and its remit, potentially. Would you see that as a possible risk around, again, interest rates in the US being subject to political pressure?
I really think
done independently.
Yeah, I really am very clear that I don't sort of intervene and sort of make comments on other people's monetary policy. So I will leave it at saying that I do welcome Kevin's appointment. He is he's a very experienced central banker.
And Ms. Greene, you've been on record as saying that if we see further significant rate cuts by the Fed, that could affect our own assumptions about inflation going forward. Would you see further rate cuts perhaps more quickly than might otherwise have been the case as a result of there being a new chairman? Would you see that as something you'll have to take into account as part of your role as member of the MPC?
Yeah, so I should point out that based on market pricing, the markets are expecting further rate cuts from the U.S., already have been for a while. So my speech really focused on surprise rate cuts that weren't already baked into market pricing. And if we were to get surprised by the Fed and we were to have additional surprise rate cuts, then that could feed through both through trade and, more importantly, I think financial conditions to the UK economy, and could, on balance, push inflation up. So it's something we should consider. It's not affecting my policy views at the moment at all, because it wouldn't be right to base policy decisions on a risk that another central bank might surprise us, but it is something worth thinking about should that risk arise.
Thank you. And just a further question to the Governor. You said recently that some of the expected shocks to the world economy, perhaps as a result of the round of tariffs we saw last year, tariff increases by the US, hadn't really come to pass as factors that you really needed to take huge account of in the work of the MPC. Do you still believe that to be the case? And are you looking at the latest round of tariffs?
Well, I get up every morning and want to.
The President has chosen to levy as a result of him losing his powers to levy the previous tariffs. Do you think that's important?
Well, I think that the comments I made a couple of weeks ago reflected the fact that actually the world economy last year, both in terms of activity and trade, was more robust than we frankly feared it would be. Now, I think, I offered a number of reasons why that appears to be the case. I think the first one I offered was you know, some of the actual action is not as large as the initial announcements. It's not quite followed through in its full effect, so that the actual tariffs have not been as big as some of the original announcements. Having said that, of course, let's be clear, the US effective tariff rate is its highest since the Second World War, so this is not trivial. But it is a fact that they've not been as large as were originally announced. Similarly, world trade has adjusted. There's no question that there's been adjustment in world trade. You can see this most obviously in Chinese trade. Chinese trade to the US has fallen, but Chinese trade globally has not. Third reason is we've had another big thing going on, which is AI, and particularly in the US. So there has been an offsetting positive effect in the US from AI, and obviously all that's gone with that. And then the third reason is that financial markets have been, frankly, more benign than, again, one might have feared. A lot of that's to do with the first three things I've given. And I think markets too, and I think I said this in a speech I gave in Saudi Arabia a couple of weeks ago, I think markets also have reached a point where they don't respond as much to initial announcements as you might expect, because they're waiting then to see what the actual outcome is.
So just final question. So you wouldn't anticipate tariffs going forward, and the new round of tariffs is on the evidence of the past year as playing a big part in the thinking of the MPC.
Well, we have to watch this
forward
very carefully. I mean, our staff spend a lot of time on this. And, I think it's interesting to look at what's been announced in the last few days. Of course, again, you take what's been announced in the last few days. Is it 10? Is it 15? I'm not really sure. Our initial staff analysis of that from the point of view of the UK is it does seem to represent a smallish increase in the effective tariff rate on the UK. But what's probably more important is that because of the UK started at a low level, this shift to a sort of more common tariff level brings other people's tariffs down relative to where we are. So relatively speaking, there's a bit of a shift going on there, which obviously isn't to our advantage. But, I think the effects of that may not be that great. I don't want to over-dramatise that. That's the sort of relative mix of tariffs. We'll see.
Thank you, then.
Thank you very much indeed. John Grady.
Thank you very much, Dame Meg. Now, Governor, people who work with the bank or at the bank have access to highly sensitive information, which could be misused and wrongfully disclosed. So, against that background, are you confident that the bank's systems and processes are as good as possible to prevent the wrongful disclosure of sensitive bank information?
I'm confident that we take it I can assure you we take it extremely seriously. We handle a lot of sensitive information, obviously going across all our functions. MPC is one of them, but all our regulatory functions obviously have large amounts of this information. We have very strong systems and processes in place. So I can assure you that we take it very seriously.
Now, I'm glad to hear you take it seriously, but I suppose gently my question was, are they as good as possible to prevent wrongful disclosure? Are you confident about that?
We have looked at all the recent events that have happened and said, where do we, how do our systems and processes stand up relative to those? I think the answer has been they do stand up well to that. But look, we all have to learn from everything that goes on around us. Frankly, the other thing I would say is that when you look at things like cyber risk, for instance, it is a constantly shifting picture. The risk is constantly there and evolving. So the main thing as a CEO that I say to all my colleagues is we can never be complacent about the position that we're in.
How often do you review your security systems and information security systems and processes?
Well, we review them, almost constantly, frankly, because of the evolving nature of the risks. But also, certainly, I can tell you, when the OBR incident happened, immediately I said to my colleagues, will you please review our practices against what we understand to have gone on in this case? Yeah. And that's, I think, good practice.
How about external validation? How often do you have your processes and systems and everything else externally validated?
We're audited. We have external auditors.
And are they professional auditors in IT security?
Well, we have a combination, actually. We have both the National Audit Office and Ernst & Young.
Okay. And then what about the culture in the bank? Do you think everyone's absolutely clear within the bank about the importance of keeping information confidential?
I think we have a very strong record and a very strong culture on this front. It is really heavily drilled into the organisation. As I say, though, every institution, every organisation just has to stay constantly on its toes on this stuff.
And from a point of view of people expressing concerns, people feel comfortable expressing concerns, however important the person about whom they're concerned is.
Well, I've tried to instill that culture in the bank since I've been governor. It's a very strong theme for me, that we must have a culture in which people feel they can say what they think. Now, look, you get feedback all the time, and I take it very seriously, frankly. But I've tried to instill a culture. When I became governor, one of the things I said very clearly I wanted to do in the bank, the two words I used was I want us to be human and humble in how we approach things, because I don't want an organisation where the culture is so hierarchical that people don't feel they can say what they think.
That cultural point, which is very important, Professor Taylor and Ms Greene, would you concur that the culture of the bank is open from that point of view as people who are external to the bank?
Yes.
Yep, I would.
Thank you, Dame Meg.
Thank you very much. From one John to another, Right Honourable John Glenn MP.
Thank you. Just a couple of weeks ago, we had the Permanent Secretary of the Treasury come in and reflect on the leak inquiry, and I think it would be fair to characterise his response as saying, well, we tried hard, we didn't quite get to it, but we're going to have closed loops going forward in the preparation of budgets and be clear about the interaction with the OBR. Are there any lessons you draw from that pre-budget episode in terms of you want to instill a culture where people can be open in expressing their views, I'm sure. But how do you avoid a sort of chilling effect of creating sort of closed circles of analysis, which means that that you don't benefit from the full expertise of the people?
Well, I mean, we're here as the MPC, so let's sort of give the example of how the MPC works. I mean, we are very strict. As we go through the process, I mean, we have more staff who participate in the meetings with us when we're being briefed, when we're discussing the forecast. When we get down to the voting process, we get down to the minute writing process, the final part of it. We do reduce the number of staff involved very heavily because those are the pieces that are most market sensitive. So that's one of the ways we do it. I mean, look, I think we were obviously close observers of that incident that you referred to. I mean, I think one of the challenges, and I had quite a bit of experience when I was at the FCA because they're responsible for market integrity, obviously, is I think there's a very tough decision at the point when the thing has got out, but it's got out to a limited number of people. Do you then take it, pull it back, or do you say no? Some people have got it. Therefore, frankly, the right thing to do is to put it out to everybody, because otherwise, some people have got inside information and others have not. I think that's a tough call, and I know that that's going to be reviewed in the.
What would you? So, what in the bank? What's your policy on that?
Well, I think. Well, you have to look at the circumstances. I think probably going back to my time at the FCA, I think we would tend to say really the right thing to do at that point is to publish.
Yeah. Well, that seems to have been the pattern.
Yeah. That's certainly when we had firms who got into that situation, in terms of, we would always say, look, you've just got to get it out there then.
Thank you.
Thank you, Governor.
Thank you very much indeed. It's been an interesting session, and it was useful to hear directly from MPC members and through the written annual reports, for which I thank you, your reasons behind your decisions on votes on interest rates. And I think we heard today very clearly what the trade-offs are that you individually make and then you come together collectively on, and that the target of 2% inflation is in sight, whatever the decisions made at future meetings. We considered the developments in unemployment, learned about de-unhoarding, which is I'm sure is going to set the world alight as a new bit of vocabulary for a lot of people, but the serious issues around the impact of national insurance and the minimum wage and employment among young people, something that we'll, I'm sure, be keeping a close eye on. And we examined the remaining sources of persistence in wage growth and inflation, and how the global economy has been affected particularly by US tariffs, but other wider global things came up a lot, that we're still dealing with the global shocks of recent years. They take a long time to dissipate. But can I thank our witnesses very much indeed? That's Megan Greene and Professor Alan Taylor, independent members of the MPC, Dr. Hugh Pill and Andrew Bailey from the bank. Thank you very much indeed.
Thank you.
Order.